morning. It's Mary Ellen McGonigal, and this is the MEM Edge Show. This is the show where we put you in front of the action in the markets. And as many of you know, I'm sure, and you're feeling it, there has been quite a bit in the way of action. Volatility remains quite high. And with that in mind, we're going to be covering a lot in the way of plays that are more defensive oriented and where you may seek shelter, so to speak. So let's go ahead and get started. I'll review here some of the items that we are going to be covering here today. And the first item that we are going to be looking at is something that we usually go ahead and review each week, and that is a review of the current markets. And that's super critical, of course. Before you put any new money to work, you want to make sure that you have the broader markets in your corner. You want to make sure that the markets are behind you. Unfortunately, not so much the case, but we'll also review where we are currently in the markets and what we need to see in order to turn positive on the markets. And then from there, we're going to take a look at pockets of strength within various sectors. While not all sectors are on all four cylinders, there are pockets of strength within these different areas. And we'll go ahead and take a look at that for your review. Also, we're going to take a look at the history of defensive groups, and with an eye toward looking at stocks within defensive areas of the market, and also looking at historically how these groups tend to fare beyond a market correction. Are these stocks that you are only going to want to hold for a shorter period of time, or can they go on for a lengthier time as far as outperforming the broader markets? And then lastly, we're going to take a look at some high dividend stocks, high yielding stocks that are outside of utility and REITs. I don't have anything against utility and REIT stocks. We'll also, if we have time, take a look at some of the better performers in those areas, but also just to introduce you to the concept that there are stocks outside of those two sectors that can provide you not only with high dividends and high yields, but also with outperformance. These are going to be stocks that are relatively outperforming the broader markets and also have that nice double edge where they provide you with a high yield. So let's go ahead and get started. Here we are looking at a daily chart of the S&P 500 index, and we can see just how messy it has been here over the recent past. So this, of course, is the correction in the October period, and we did have a nice recovery attempt here. This nice spike up here is the after the midterm election, the euphoria in the broader markets really got people excited. So unfortunately, subsequent to that, let's just take a look at this day again here. This is that Wednesday, a week and a half ago. We had the Tuesday midterm elections, the split Congress, markets like that, and the S&P 500, among other indexes, did have this very nice gap up on big volume. And from my work, we did have what's called a follow-through day, and that is a day where the markets are up at least 1.2% over the prior day, and it's on increased volume. The reason that I'm pointing that out to you is that anytime we do have a pullback or a market correction, that follow-through day is the number one action that we need to see that would potentially indicate a reversal of that correction or of that downtrend. So we did in fact get that. It was certainly exciting and encouraging. However, the market subsequent to that has sold off, and that is not a good sign. When you have that follow-through day, you do ideally want and need to see the markets continuing to advance. And then secondarily, I pointed this out in the past, is the importance of paying attention to the current price of these broader indices relative to these simple moving averages. And on the S&P 500, today I have a 10-day simple moving average, this green line. The red is a 50-day simple moving average, and the blue is the 200-day simple moving average. Quite simply, these are smoothed out lines portraying the price history, in this case going back 10 days, 50 days, and then 200 days. And these simple moving averages are highly relevant when you are looking at the broader markets. You want to determine, are the broader markets in an uptrend or not? And certainly when they break below, in this case, first below the 10, then below the 50, and now below the 200-day simple moving average, that is really unhealthy. So our first signal that the markets may be potentially regaining their health is we are going to want to see a break back above these simple moving averages. And we did get that certainly back here prior to that actually on the day after the midterm election, we did get that break up above that 200 in addition with that follow through day. So we got a couple of very positive signals, which of course have not carried through since then. We're now back down below this 200-day simple moving average. So our first, we're back at go, if you will. The first indication that we are going to need to see is a break back above that 200-day simple moving average. We're not going to be entirely out of the woods until we get back up above this 50-day simple moving average. So currently we have two barriers to the upside. And then of course, ideally, we want to get back to these prior highs to really be back on track. And we can go back, take a look at this period here during this February correction to get a sense that when we get this type of damage, it really does take time to recover. There, in this case, you can see we had a number of false starts before we finally got back on track during the May period. Another item to point out is these other secondary indicators. In the case here, I have what are called the stochastics down below. And we do want to see the stochastics. We're looking at a daily price chart. The stochastics to come back up above this net neutral, this dashed line, in conjunction with an RSI that is also positive up above this dashed net neutral. So currently the RSI is appearing to try to trend upward. Let's go ahead back again. The stochastics are up above this net neutral here. Now this is as of the close on Friday. So today's action in the market, of course, is going to have an impact, but you do want to see those indicators lining up with the index going back above your key simple moving averages. We can take a quick look here. This is the NASDAQ composite. This is a weekly view, and we can see really just how much the NASDAQ has been struggling. And this too is below, in this blue line is the 200-day or 40-week simple moving average. The red is your 10-week or 50-day simple moving average. And we can see very much they are below. And also your RSI up here is trending negatively. The stochastics, this is that May period when the broader markets turned positive out of the earlier in the year correction. And we can see really the stochastics are well below this net neutral, which we would want to see the stochastics breaking back above in line with the indexes going back above these simple moving averages. So these are guidelines really to help you determine where we are as far as potentially returning to a more bullish stance in the broader markets. Now let's go ahead. I'm going to take you now over to stockcharts.com, and this is where we can take a look at what's called candle glance. This is accessible from that first interface page on stockcharts.com. And here we can see what I've done here. These are 12 thumbnail snapshots showing you 2 months of price activity of various indexes. And so I've populated this with ETFs as well as with broader market indexes. From there, I've overlaid an RSI, a relative strength indicator. You can certainly populate it with the indicator of your choice, but I like to see the relative strength of these various indexes, broader markets. We also have gold, the VIX is here as well. And from there, you can sort by RSI in descending order. So we're looking at strength to weakness. So up here in the upper left side, I have XLP. That is your consumer staples, and that is an area that is continuing to outperform the broader markets. And as many of you know, this is an area that is generally defensive. It does have higher yielding stocks, but also there are many growth stocks in there as well. And we will get back into that as we move on. Utility stocks, another area, higher yielding, is second as far as relative performance over the last 2 months, followed by gold. We're seeing a little bit of a rally in gold, but let's take a look at some of these sectors in the broader markets that are not necessarily all defensive. Healthcare is defensive. We can see that it is outperforming. Certainly the Dow Jones is here. We have the S&P 500. So healthcare is really holding in remarkably well. There are some wonderful pockets of strength within that healthcare space. These are names that not only offer you yield, but also growth. And so we can take a look at some of those names. The VIX is here. So as we drill down into weakness, we can see small cap stocks are still struggling, and that is not what you want to see. Ideally, you do want to see small caps performing either with the market or certainly better than the market. That would be another indicator that we are emerging out of this corrective phase. Technology is continuing to struggle. Apple is a big part of that. The stock is down yet again today after being off 5% last week. The NASDAQ, of course, is tech heavy. Biotech is in there, and biotech stocks are struggling as well. And then lastly, I have consumer discretionary stocks. And it's really unfortunate that this particular sector is not doing well here recently, primarily because they were a leading group, certainly for most of last year. A lot of the retail, specialty retail stocks, apparel, and so forth were really outshining and doing quite well relative to the broader markets. More recently, despite coming in with strong numbers, discretionary stocks are in fact suffering. So a number of discretionary stocks are going to be reporting this week. So it will be, of course, interesting. We have Target, TJX, and a number of bigger, well-known stocks coming in this week. Last week, they came in with good numbers, Home Depot, Walmart, and so forth. And the markets, they did sell off despite coming in with good numbers. Now, let's go ahead. I talked about taking a look at stocks that are not necessarily in the utilities and in the staples, but they are stocks that are offering very high yields. And I'd like to introduce you to some of these names, give you an idea of areas that are outside. And the reason is oftentimes utility stocks will have a life that expands during a corrective or pullback phase, but they won't go beyond that much. These are stocks that will and can outperform even during healthier periods of the broader markets. So what we're looking at here is a ticker EFC. It's Ellington Financial. And this particular company, we can see how it really did excel back in this May period, again in August, sold off with the broader markets, but is attempting to come back. The company offers a 10.3% yield, and they just reported earnings. So if you see this gap up here, this was the report of their earnings. They had 52% year-over-year earnings growth relative to the prior year, 10% ahead of estimates on their earnings. And if we look, let me go ahead and take you to a weekly. This is a daily view. Taking a look at the weekly, we can see that the stock is potentially emerging out of an oversold position. I can take a quick minute here and pull up the stochastics so we can get a better feel for that. But the other item to note is the fact that this company, they acquire and manage mortgage-related assets. So you can see, again, if we scroll down here, we can see that the stochastics are just now turning positive. So the stock very well may continue. It's a 400 million, so it is a bit smaller. Let's take a look at another example. The ticker is SCM. And this particular stock also came in with earnings. It's Stellus Capital Investment. And this particular company, as mentioned, it too is quite small. It's a $200 million company. Doesn't mean it does not have the ability to outperform the broader markets, but they did come in here. This is their recent release of earnings. They also had very strong earnings and sales that were ahead of estimates for Q3. Also, analysts are revising estimates higher for next year. This particular company, they invest in private middle market companies. They provide liens. Let's take a look at another PNNT. This is Pennant. Actually, I forgot to mention, SCM does provide a 10.2% yield, and Pennant is a 9.8% yielder. And this particular company, they did also report earnings that came in ahead of earnings, ahead of estimates. Now, this stock does not appear to have quite as much in the way of strength. It's still struggling around this 10-day simple moving average, but we can see the RSI is trending positively. Your stochastics are poised to come up above this dashed net neutral area. And to give you an idea, this particular company, they invest in middle market companies, real estate, hotels, gaming, manufacturing, all kinds of different industries. It's a $500 million stock. Let's take a look at another one. This stock is ARCC, a 9.1% yielder, a little bit bigger. It's a $7 billion company, and they too just reported here. They came in with earnings and sales ahead of estimates. They invest in manufacturing and consumer related product companies, and again, a 9.1% yield. GNE is another stock. This one is a 4.7 on the yield. It's just potentially reversing this downtrend. We can see we're looking at a weekly. The RSI is positive. Your MACD, actually stochastics, also are above this net neutral. And this particular jump here, again, was on very strong earnings. They are a retail energy provider, a reseller of electricity, if you will, another one. We can take a look at one more example before we move on. And this is an area that really has blossomed of late. This ticker is CECO. This is a pollution control company. And actually, looking at it on the weekly, I have to tell you, it's not as interesting as I had potentially. That's because I put the wrong ticker symbol. Forgive me. Let's go ahead and give this another try. It's CECE, and we can see this is quite a different look here. We can see the stock pulled back, has now reversed back up above. It's now an upward trending 10-day simple moving average. It's above the 50. Your RSI is positive, and your stochastics are also in positive territory. So as mentioned, this is a pollution control company, 3.6% yield. They just came out with super strong earnings, 233% earnings growth versus the prior year, 11% above estimates. It's a $300 million market cap, but the company, they are revising earnings estimates up so that they're looking for 62% in the way of earnings growth next year. Let me show you another stock in this industry group that is breaking out today. This is Waste Management. This particular stock has a 2% yield, but it is an area that's picking up. I would view this as defensive in the sense that there is always going to be a continued need for waste removal. It's not going to be impacted by any tariffs or any headwinds from maybe a potential slowing economy. So those are some examples of stocks, again, that are outside of that normally defensive area of utilities and consumer staples. Another area that I wanted to have you take a look at and share with you are companies and areas that are outside of the U.S. We are starting to see a pickup in areas. The first one that I will show you here is India, INDA. Now, of course, it's quite difficult to invest in individual stocks in India, but we can certainly take a look at the ETF here. We're still a little bit early. This is a daily chart of INDA, that is the ETF for India. But the reason I'm pointing this out to you is India had really been outperforming all of the other emerging markets going into September. And we can see that it really fell out of bed, so to speak. And this fallout has everything to do with the rise in oil prices. For those of you that follow oil, you may know that during that September-October period, we had a big advance in the price of oil. We can certainly take a quick look at that just so you can have a better feel. And the reason for that is India imports most of their oil. So it really was a great negative impact to them. Of course, oil has certainly fallen out of bed here. More recently, we are in a bear market with oil pricing, but this is that spike that I was pointing out to you that really did have a negative impact in India. But now we are starting to see a reversal, and those that are experts in emerging markets are scooping up shares of Indian stocks. There are some ADRs that you can take a look at, Indian banks and so forth. And then we can take a look at another emerging market space, EWZ. This is Brazil, and Brazil is picking up here. Again, there are Brazilian ETFs that trade, ADRs that trade on the US market, Brazilian banks and so forth. But that's another area that is picking up for those of you that are looking for potential areas outside of the US, given the current condition of the US markets. One last ETF I'll show you here is also Indian related, but this is consumer. It's both consumer staple and consumer discretionary. We are still a little early here. This is a daily chart, INCO, and we can see that this ETF has broken above this 50-day simple moving average at 41. It very well may continue to advance up to 45, which would be a 10% advance. But from there, you could very well have resistance at this downward trending 200-day simple moving average. Let's take a look at another ETF that really has been holding up here well. And the ticker symbol is DOD. And oops, let's go ahead and try that again. And it's called Dogs of the Dow. And for those of you not familiar, these are going to be very high yielding. What this ETF does, it takes the 10 highest yielding stocks from the Dow and has created this ETF. So it's just another thing that potentially you could take a look at. Again, for those of you that are looking for ideas outside of the US markets. So let's go ahead back and take a look at areas that are defensive, and I can give you a very quick view of how you can get in front of the best performing, but also the best looking, if you will, technically within those given sectors. So what we're doing here is from that first page, I went to the sector summary, and this initial interface is going to show you the percent change for the day. What we're going to do from here is go ahead and drill down and take a look at utility stocks. And we talked about this being a wonderful hedge, if you will. There are a lot of stocks within the utility area that are really outperforming the broader markets, but more importantly, that offer you that higher yield. And I will tell you that these water stocks, what we can do from here is go ahead and overlay your cursor on that symbol, and it will give you a quick thumbnail shot of the group, the industry group, and we can see really how strong these have been. But let's go ahead and take a look at water utility stocks. And what you'll want to do is go ahead and click onto the name. Again, the first interface will be performance per today. And from here, you will want to go ahead and sort it by this scooter, SCTR. This is a technical indicator that was developed by John Murphy, and it's really super powerful. It goes back actually over 2 years as far as the metrics that are included, but most of the weighting is going to be on more recent activity. So what you'll see here is the higher the number, the better. and we can immediately take a look at AWR, American states, and take a look at this advance. And what we're seeing here is a daily price chart. We can see that the RSI has trended and remains in very positive territory. The stock is continuing to find support at an upward trending 10-day simple moving average. The same for the MACD down below. We had a crossover, the black up through the red line, very positive. And we can see that that is certainly the best performer, but it also still looks really quite positive. We are back here at the utility water, and you can see we really can go down to any number of these companies, take a look at the stock, and you will see a very similar dynamic where these stocks, the 10 days simple moving average is very much in an uptrend. Stocks are finding support at that upward trending moving average. Your RSI is positive, as is your MACD. So that is your simple way to get in front of these better performing stocks that are also technically sound. Let's go ahead and take a look at a different defensive sub-industry grouping here. What we can do here, of course, is take a look at consumer staple. And so this is XLP. We go ahead and click on to that. From there, we're getting the sub-industry grouping sorted by percent change today. Not all of these are going to be as interesting as others. Again, thumbnail tires, we can see that that is just beginning to reverse. Brewers, soft drinks are going to be more interesting to me, simply because take a look at that performance on a relative basis. Truly outperformers. Strength will tend to beget strength, if you will. We can then go ahead and sort it by scooter. Now, this one, I will tell you, has been running for quite some time. KDP, it's Keurig Dr. Pepper. So this is not going to be as interesting to me. Take a look at why. The RSI, we're looking at a daily price chart. The RSI is up above this 70, and this darkened line shading indicates that the stock is overbought. It's pointed out with an eye toward a potential pullback, if you will, at some point in time. And we can go back here historically when it was similarly overbought, and it did at some point, of course, decline from that area. Taking a look down below at the MACD, this stock, of course, would have been a lot more interesting in the early phase as the MACD begins to trend upward, black line up through the red. And now the MACD is potentially turning downward. So these are ways to get you in front of potential candidates, ideally defensive. I've also shown you how to get out of the US. I also want to encourage those of you not familiar to take a look at my website. It's meminvestmentresearch.com, and I am always available to answer any questions that you might have, anything that I've covered and reviewed that you may want to get a bit more insight on. We do have time to go ahead and take a look at one other area within consumer staples. This is food products. Again, we will go ahead and sort it by that scooter. Again, these are your big performers up here. A lot of these are going to be oversold as well because they have been running for quite some time. We'll take a quick look at MKC McCormick. It is very much still in an uptrend, but you can see you're not particularly early to the party, although it does still look to have more upside potential. And I'm going to go ahead and leave it at that. To everyone, happy trading.